Hey everybody, hope you had a good weekend and welcome to another edition of Manual Libra Trading and Research. This episode is entitled Tariffs On, Tariffs Off, All a Big Game of Chicken. As always, quick disclaimer, fine podcast is for educational purposes only. This is not a solicitation to buy or sell commodity futures or options. The risk of trading futures, securities, and options can be substantial and may not be appropriate for all listeners. All right, guys, we're going to start this video out with a little snippet from J.B. Shirk from the American Thinker and his piece entitled There's Nothing Free About Free Trade. And this is the American Thinker here. We know that Trump has been playing a massive and somewhat strange game of chicken with global markets by announcing day-to-day changes to the administration's tariff strategy. Many accounts on Friday were reporting tariffs were now exempting smartphones, computers, and other electrical devices imposed on Chinese imports. No doubt the markets took this to continue their bullish rebound. What is strange is this inconsistency seems to be causing volatility both up and down, and this is not what we want for markets if you are an investor for the long term, because this increases day-to-day volatility. This kind of rhetoric leads to a lot of uncertainty and poses a sort of chaotic underpinning to an already fragile economic environment that has been stifled by inflation and higher interest rates. We don't like that the Trump administration is playing chicken here with the people's lives, with their businesses, and we do not like this game of playing hardball to only then acquiesce in certain circumstances like they did on Friday, especially when we have seen a lot of Wall Street masters crying on social media, Bill Ackman, one of them, about this initial tariff implementation and its results. Anyways, we figure we would highlight this recent post here from the American Thinker, and I'll share the link below in the show notes. It's an absolute must read for all my readers and listeners. We believe this piece and the fundamental premise of what it states are profound and will prove to be correct in the not too distant future. His conclusion that he makes is spot on, and let's read a little bit here about what we think is the most important part to understand. And here a little snippet here from this post. In truth, the American empire hasn't been interested in free trade since at least World War I. The Great War, coincidentally enough, started roughly 6 months after the Federal Reserve System was forced upon the American public in a corrupt congressional vote 2 days before Christmas in 1913. The creation of a central bank was a dead giveaway that markets would henceforth be controlled. Nothing that is centralized can be said to operate according to Adam Smith's invisible hand. From that point on, central bankers chose the winners and losers in the American economy, and free trade became a euphemism that global oligarchs whispered to the American people while stealing every last cent from their pockets. His conclusion is also dead on, and we'll read it here. President Trump's tariff policy is only the beginning. He is setting the stage for the end of the income tax, the IRS, and the Federal Reserve. Getting there requires unshackling the American economy and unleashing America's entrepreneurial spirit. Now, whether or not this all comes about, we aren't sure, but it definitely makes sense. We think you guys should give this a read and kind of think about what is being said here and what is being talked about in this piece. So we want to share with you guys here. Also, we'll move on here and look at the All In podcast. We're not sure if you guys ever listen to it, or if you don't, we definitely suggest that you do. Every episode is kind of a big learning lesson in a lot of the things that we believe are important going on in the world, and they do a great job on this podcast. So we definitely think you guys should give it a listen if you can. In this piece that we're going to cover here was this week's edition with Larry Summers, and David Sachs did his best to keep his composure. And one of the moments we enjoyed is when Summers tried to say that Americans' exports did rise after letting China in the WTO, which David Sachs aptly replied, "Yeah, at the cost of massive deficits." And this is classic and an excellent example of how to argue against a single point of truth. But put in context, it doesn't sound so lucrative, meaning, yeah, maybe our exports grew by a few percentage, but at the cost of billions and billions of dollars in deficits. So we're going to give this a little quick listen to here, and it is in 1.25 just to speed things up. So I apologize for if it sounds fast. Here we go. We're going to play this little clip here.
Okay.
But my question predated that debate.
Yeah, we're trying to
Listen,
get
you're trying to change the subject. Let's just finish up on this topic.
We're trying to move forward. That's all.
No, we're trying to finish up on this topic, okay?
Okay, we'll let you get the last one.
About this.
Okay, you can have the last
word. So March 9, 2000, Bill Clinton announces PNTR at Johns Hopkins. It's a very famous speech. Liam, maybe you can tell us about how it got written. Anyway, Bill Clinton promises several things. He makes a number of arguments for PNTR. He does not think that this does nothing. Larry, your argument is that Bill Clinton didn't do anything. You're saying that somehow it happened under Reagan or something like that? That's not what Bill Clinton was arguing. He said, number one, there'd be huge economic benefits for the U.S. He says, quote, By this agreement, we will increase exports of American products. He means to China. That will create American jobs. Okay, did that happen the way we intended? I don't think so. Number two is he believes that.
Have you looked at the data on export flows from the United States to China? It actually did happen at a quite substantial rate.
But with huge trade deficits for the United States.
And that's the point we wanted to make, at huge deficits to the United States. So this is a great listen to, guys. It's I think it's about 2 hours long, but definitely worth to listen to. So I want to share that with you. We'll leave a link to the YouTube sorry, not Joe Rogan. We'll get up to Joe Rogan next, but the All In podcast in the show notes. So definitely give these guys a listen to. Like we said, it's a learning lesson every time, and no matter how many times you go back and re-listen to it, you're going to pick something else up. So these guys are educating people out there. And we definitely think you should listen to this episode with David Sachs and Larry Summers and Ezra Klein. So give this one a listen to, guys. We'll share the link in the to the YouTube All In podcast. Next up, we're going to go to the Joe Rogan Experience, and we'll click that up here. Get this ready to get queued up, and we definitely think you should give this a listen to as well. This episode with Douglas Murray and Dave Smith. This seemed like what was trying to be done here was the intent was to try to discredit mainstream podcasts like Joe Rogan that bring on comics like Dave Smith, who are obviously very vocal about what's going on in Gaza, and a lot of the mainstream journalists don't really like it because they're pointing out things that may or may not be true, or may be highly opinionated and not have all the facts. But in reality, I think what Dave Smith tries to do is just enlighten to what's going on, and I see nothing wrong with that. Look, we are very big on being pro negotiation, not really resorting to mass casualties and war and death and destruction, but more diplomatic approaches. So we don't mind that somebody like Dave Smith or Joe Rogan is going to bring these things to the forefront for more discussion. There's nothing wrong with that. However, what Douglas Murray came to understand by being on here, we think, is that the American population finds these outlets informative, thought-provoking, and ask a lot of great questions that many do not have the answers to. And I think that's what the American public is actually looking for, just some clarity. Not necessarily having to agree with either side or who's at fault or this or that, but just more clarity and more information about what's going on. So in this clip, Douglas Murray, in his best accent, tries to discredit Dave Smith for calling out the Israeli atrocities against the Palestinians on the basis that Dave has never been to Gaza, as if that discredits his known facts and opinion, which is kind of crazy in this day and age of AI and metaverse and everything. You pretty much can go anywhere and find any data you want without actually having to be there. But much like Larry Summers' argument, that is a tactic that many debaters try to use and create for the observer a sense of lack of merit based upon not actually being physically present, as if that matters, which we do not think it does. But it clearly doesn't matter. So we don't live in a world by which information is restricted. We live in a world by which many millions report on actions each and every day, some more credible than others, obviously. So you have to kind of vet your sources, but we have a lot of information that we have access to, and a lot of data that we never did before. So this is all part of that waking up movement, guys, that red pill movement. And we think it's pretty interesting to see somebody like Douglas Murray go at it with Dave Smith and Joe Rogan here, and try to discredit mainstream podcasts for being insightful of misinformation, when in reality, all everyone's trying to do is just get a better understanding. So let's listen to this little snippet here where Douglas Murray tries to discredit Dave Smith on the basis that he's never been there, as if it matters.
No, there was no deficit of goods coming in. I've been plenty of
There's
times.
no deficit?
No, there are
No
plenty
goods were kept out.
There are plenty. Have you been to the crossing points?
No.
When were you last there at all?
I've never been.
You've never been.
Well, am I not allowed to talk about it now? I've never been to. Have you ever been to Nazi Germany? Are you allowed to have feelings about them?
You can't time travel, but you
Well,
can.
right.
But you can travel.
Okay, but so what? So what's the point? Like,
No,
okay.
I find that
Lots
very...
of people have been there and agree with me, and lots of people have been there and agree with you.
Yeah, but
so
if
I don't
you're
know
going to
what
spend a year and a half talking about a place, you should at least do the courtesy of visiting it.
all right. I just think this is a non-argument.
You don't think?
Okay. No, I think it's a non-argument.
But if you're an expert,
Well, you have to go and touch the ground.
No, I think you have to
see.
see. I think it's a good idea to see stuff, particularly if you
Okay.
spend a career talking about something. Yes, I have a journalistic rule of trying never to talk about a country even in passing unless I've at least been there.
Okay.
It's
But
a
that's
sort of
not
normal. It's a normal thing to.
Okay, so that's just a little piece there. It's not normal, he says. We kind of disagree with that thought process, but in general, we know that that's not the case, that you don't have to be somewhere to kind of be an expert. And, we feel like this is just something more that they try to push onto people, that, to try to discredit them, when in actuality, we think it's a non-issue. So, it's just something, one of those things where they try to bring Douglas Murray on to try to discredit Dave Smith, but I don't think it went very well for them, because it just goes to show that people are in need of information and are curious and want to know more, and people are kind of sick of the endless wars and the atrocities that brought upon innocent people, and that's kind of the reality of it. Nothing more. I don't think it's any nefarious more than that. Of what Dave Smith's trying to do is enlighten people and to more information. It's not a matter of taking sides. It's a matter of just getting clear-cut information out there, and going from there, and saying, like, this is kind of needs to be more discussed. Like, this is what we're kind of doing. So, all right, let's move on here, guys. Just thought we're going to leave the show notes, the link to that Joe Rogan as well. And before we get into kind of the technical side of things, let's look at last week's settlement stuff. Let me just drag this over here real quick, and so we'll take a look here at last week's settlements. You can see that the bond market, it was hit again, front end kind of weaker there. And the equities here, you can see we're up pretty big on Friday. So good end of the week for the equities, good end of the week for foreign exchange markets, energies in general, and metals are all higher. So want to keep an eye on that stuff. It's kind of like it's not a change in trend, but it's the rebound of the risk off that we saw. It'll come too far, too fast. So that's kind of what we're seeing there. Over the 30-day changes, we can see here. Obviously, the Swiss franc and the gold are the big winners. You can see them here. Gold up 7.2% over the last 30 days, and the Swiss franc here up 8%. And then obviously nat gas and the DAX have been big losers, giving back some decent chunks there, 15.7 and 11.6% there. As far as the U.S. yield curve, it reversed the steepening from Thursday to flattening out on Friday, as yields were way up here on the front end, which is kind of what we're looking at right here. This is yields are way up on the front end, up 10.5 basis points in the 2-year, 11.9 in the 5-year, and then barely up in the 30-year, up 2.5, which leads to a flattening, guys, which is when you see these curves here. This is the 2-year versus 5-year, 2s versus 10s. This is the yield curve differential, the yields differential between those two, and when they're in the brackets here, that means they've moved lower, that the yield curves have narrowed up. So it's a reversal of the steepening trend that we've been seeing, and this is more of a flattening. But just profit taking, guys, all based upon this volatility by the Trump administration, saying one thing and then doing another, and we, like we said, nothing's fundamentally changed, guys. This whole basis trade, cross-currency basis swaps are still an issue. The basis trade is still an issue. None of that has gone away, but just this is the difference between long-term investing and trading. We're going to get these short-term movements of risk on, risk off, and that's kind of where you can't get caught up and beat up in between. But we see nothing fundamentally different that changed from 3 weeks ago to last Thursday and Friday. So this is just more of reversing out of some of these trades that probably came too far too fast, and that's all we're seeing there. And in regards to our Magna Libra CTA market sentiment tracker, we can see here that the bond did move, the long end here moved to a short bias. All the equities have moved to neutral now off of this rebound here, and including the Aussie moved to a neutral position, and the British pound moved to a +1, along with silver and copper now long again here. So this is our CTA market sentiment. What we like to do with this is to get the actual bias, long or short, in the complex itself. Like, this would be the fixed income complex, this would be the equity complex, this would be the FX complex. Down here you have energies and metals, and so we got to take them as a whole. Like right now we've got fixed income obviously in the longer end leading to a shorter bias, with the front end still being neutral. And by front end we mean the shorter duration notes as opposed to the long end 30-year bond. So that's what we try to do with this. These equities were in a short bias for a little bit of time as they reverted off their highs, and now we've gotten into a neutral status as we're consolidating here off the lows, which is what you want to see, kind of a basing pattern out, and it's reflective in the bias here in our proprietary indicators that the equity markets are now in a neutral status. So probably sideways. That doesn't mean the trend's not down overall. It just means right now that they're kind of more neutral bias, and no real look either way in regards to up or down here. We can go either way, but it's more of a sideways indicator here for now. And then let's move over to the Mega 8s. Group gained about 350 billion on Friday. Apple and Nvidia, the big winners, up 4.1% and 3.1% respectively. We aren't sure what we're going to hedge with this week. We do think the market can continue to gradually move its way off of oversold and into a higher mode, but we aren't sure where that where that hedge would be. It would most likely probably be up in the 475, 480 area for a hedge if you were going to sell calls. But we'll see. We'll take a look at the tech charts here in a little bit. But for now, the Mega 8s had a nice rebound on Friday. And the magnet for these guys will be the 21 period moving average, which you can see it here on the overall market cap chart of this grouping. Back up, getting close up to 16 trillion overall market cap there. So this is our 21 period moving average. We expect it to magnet and be a resistance point for now. But as you can see, the trend is down, and that's kind of what we need to be looking at. But you can see also going back, you see we've into major supports, and you can see those on the triple Q charts as well. But some good areas for long-term buyers to come in and step in and support. That doesn't mean we're not going to break down and go back into there. It just means we know it's come too far too fast, and time needs to smooth this out over this way. So that's kind of what we're looking at. In regards to the strategy B, the Bitcoin buying company that's swapping debt for an equity for Bitcoin. This is the covered call tracker. Volatility has increased quarter over quarter from Q1 to Q2, but we know it's down overall from Q4 2024. But we know volatility is one of the key drivers to this, and you need higher volatility to keep the pricing up. But it's still down a little bit slightly, even on the covered call strategy. The stock itself is down quite a bit, but you can see as selling the calls is kind of almost covered that entire loss of the equity moving lower by selling options there. And that's one of the things we try to do with this and why we keep presenting this data, because we want to see if this ever, the equity starts to outpace and we start to really get a big dip in the stock price versus even the call selling strategy. So that's why we're keeping track of this. For you guys. But for now, as long as the Bitcoin price is stabilized around 83, 84, 85,000, then this should do okay. But we start to get a dip again, and then we'll probably see the equity get tumble again here. But that's why we're keeping track of this data, so we kind of can stay ahead of it. All right, let's go through the charts on TradingView and see what stands out. Let's take a look at first the triple Qs. In regards here, the triple Qs, this is the one, I believe it's a 1 hour chart. So you can see back up to this 460 resistance point here. When we look at the weekly, let's move this to a weekly, get to there. You can see, let's widen this out. This is our bull bear pivot line, and we expect a battle here, guys. It's a nice, obviously hit that first longer term buy area down here. Move this over a little bit, widen it up. And obviously big buy from the 413 level. Actually, what the low did they get down to? 402.39. So nice bounce here, guys. Another 60, 50 handles or so. But obviously this is going to be our target 45, which we just talked about prior. Where we're going to get up to there, maybe not this week, but as long as the bulls can keep us around here, then the potential for us to move back to 45 is there. But for now, we expect this 460 to be our bull bear pivot, and you can see already starting out this week, we're battling around it. So keep an eye on the triple Qs for the overall market direction here, because this is kind of the index that has been the leader. This is like the NASDAQ. We'll take a look at the NASDAQ futures as well, but we expect this to be the battle line this week. So below here, we can risk a little bit, eat into the bounce here, that down here, but above it, we can expect to try to keep pushing our way to 485. So that's the triple Qs ETF there, guys. Let's look at the 10-year. Obviously, 437 is still our marker there on our longer term charts, and we're a little bit above it now. we got close to 460 here, but now we're back at the 4.41%. But this is our line in the sand, 437. The risk is to obviously above it, we can continue to sit up here and stay elevated here, but below it, we're going to try to keep ourselves uh, into this situation where we're getting back into this downward trend line if we get below 437. But the first time rejection back out of it seems pretty obvious. A lot of big selling out of Japan and China here to get the yields back up to raise cash, but we expect this to get worked off and we'll generally make our way back down into here because we think the rates are generally going to be trending steady to lower, not higher from here. So we'll keep an eye on the 10-year, but 437 is our line in the sand. A lot of you guys already know that and have seen this from us before. Let's look at the S&P 500 futures. Obviously, the first long-term buy support area and second long-term buy support area, we're almost hit here down here, 48.08. I think we got to 48.32. So not right on target there, but you can tell a lot of value players are going to be buying into here because you're buying back in 2024 levels. So we often talk about going back in time. Well, you're going back over a year and a few months if you're buying down here at these levels. So you got some good value there time-wise. Price-wise, not so sure, but for now, obviously the big jump in the S&P 500 futures here, and our real first resistance is 55.25, so we're still about 110 points away from that on the upside, but right now the bulls are in control above this 53.38 area. So bulls are in control here for now, and like we said, this is kind of consistent with a kind of an come too far too fast, kind of work this oversoldness off, and then reestablish whether or not we stay above 53 38 40 area or if we get back below it. But for now, obviously you can see the big top that's been put in and the damage that's been done. We're just working off some of this oversold now. Now, whether we reassert this trend back down is another thing. For right now, the bulls are in control. And you can see the same thing on the NASDAQ chart. 18,961 is kind of our weekly bull bear pivot area and first initial sell, which is kind of, we expect them to respect this area for the initial time up, but ultimately 20,000 area is where the real resistance is going to be if we can get back up there. We're not sure if we can, but we're going to expect a battle around this 19,000 level. So to start off the week, and it looks like we're doing that right now because did get up to 19,256, and now we're back down to 18,800. So expect the battle to continue. Like we said, guys, nothing's fundamentally changed. Trump is hell bent on getting this trade situation back in balance, and he'll acquiesce here and there. But ultimately, we do believe this is something that's going to continue on here. So we're not out of the woods here equity-wise yet. We just, like we said, we are in a more consolidative, work-off oversold indications down here that we need to kind of just take time to work that off to reassert the next new trend. But overall, you can see the trend is down. So nothing has changed that. Trend is still lower, even though our CTA market sentiment said we're in a neutral status. It's only because we're working off oversold conditions here, and time will reassert things in regards to either this short bias or not. But for now, it seems that the bulls are in control for now, but this could change rather quickly. Let's see what else we want to look at. Well, look at the euro. Nice explosion. We talked about breaking this trend line here, this 110 area, and wow, we've really gone up. So we can kind of just move this stuff. In regards to the Fibonacci's, we can go all the way back up to here now that we've broken out. So we've full recovery back from 2022. When we look at kind of this area here, where this is where we're looking at the resistance point now, but ultimately it looks like, well, let's flip this around, guys. We like to look at it this way. And we love Fibonacci levels. We do believe it's consistent with how most things trade with in regards to natural flow of things. And so we're right around this 618 at 113.07. So we're going to expect this to be a battle point as well. Ultimately, 117.73 should be our target reversal area, but right now we're going to suspect a little bit of sellers here at being the top here from February 22, actually in July of 23, and then now again here. So let's expect sellers here to kind of just take their shots. Knowing that the 618 fib is right here as well. If we can start back below there, what will happen is these new shorts that are entering here will look to drive it below here, and then they'll place their stops somewhere above this level here at 114 most likely. If we can get a settle below here on the daily, the shorts will reassert themselves and try to pressure back down to this 110 area. So we expect sellers here initially at this 113 level. Not going to surprise us if this market waffles around here for a couple days in that regard. Let's move over to crude oil. Crude oil, obviously 54.35 was big. We've bounced from there, didn't quite reach it, but we've bounced from there, and now it becomes our range now, guys. So 66 to 54 is our new range. In this regard, we think that's a lot of risk. You're talking, 20% worth of risk here, but on the weekly, we believe you have to respect that because these moves are large, and you don't want to get caught beat up. Obviously, your short-term traders are going to be trading this up and down, but longer term wise, we don't expect sellers until 66 and new buyers to emerge down at 55. So we're kind of in between there, guys. Nothing to really see right now, other than the fact that the trend is down in crude oil. And we can look at gold now. Let's take a look at gold futures here real quick. Get this out of the way. Big up move out of this trend channel here, and now let's remove this Fibonacci. And now we're kind of just in no man's land, guys. We don't know. Maybe this goes up to 3,500. Maybe it falls back to 3150 area. So once again, just a big move bust out of this trend channel area. Obviously, big bulls in gold here, and any backups will probably be bought until we get back below 3,100. So we're going to say longs are going to be okay as long as we don't get below 3,100. And that's kind of how this will play out, is what it seems like to us. All right, that's it, guys. It seems like this one's getting a little bit long. I apologize. We had to go through a bunch of stuff here, so let's keep things positive, guys. Hope you guys all have a good week, and hopefully you guys hit that subscribe button. What we'd like to do is, we offer you guys a different mindset that you don't get anywhere else. We offer data across a multitude of market segments as well, and we structure our data in a unique way that we believe allows you guys to benefit from looking not only at nominal price action, but the dollar values that are tied to it. And then we offer in-depth vantage point and incorporate our work into your own investing and trading process, what we hope that you do. So we hope we kind of promote your mindset in ways that you might not have thought of before, and it makes a difference in your own personal life. So sign up today, guys. You won't be disappointed. Obviously, you'll be the smartest person in the room if you do, because all the data and information, the way we provide it, we think is unique. And then when others are pretending to know, you guys will know that you're the ones that really truly understand everything. So that's it, guys. I hope you have a good week. We'll be back for our subscribers this week with our weekly and daily data. Till then, cheers.